I was interviewing a G7 finance minister last month when I asked him point blank why his country still maintains 783 tons of gold, worth $49 billion in underground vaults, when that money could fund healthcare infrastructure or education. He looked at me, paused for a moment, and said something I'll never forget. Because when the phone rings at midnight and another country's banking system is collapsing and they need emergency support, they don't want our currency or our promises. They want gold. And if we don't have it, we lose the conversation before it even starts. That answer revealed something fundamental about power, trust, and how the global financial system actually functions when the pleasant facades fall away. Let me start with the numbers that show just how seriously nations take gold reserves, despite living in what we're told is a digital, modern financial era. According to the World Gold Council, governments and central banks globally hold approximately 35,600 tons of gold as official reserves. At current market prices around $2,000 per troy ounce, that represents roughly $2.3 trillion in value, locked away in vaults from Fort Knox to the Bank of England to the vaults beneath Manhattan. The United States leads with 8,133 tons valued at over $500 billion. Germany holds 3,355 tons. Italy has 2,451 tons. France holds 2,436. Russia has accumulated 2,335 tons. China officially reports 1,948 tons, though most analysts believe the real number is significantly higher, given their lack of transparent reporting. These aren't small positions that nations maintain out of tradition. These are massive strategic holdings that cost billions to store, insure, and secure, yet countries not only maintain them, but are actively increasing them. I created a graph showing annual net central bank gold purchases over the last 15 years, and the trend is unmistakable and accelerating. From 2010 to 2014, central banks were adding an average of 420 tons annually to their reserves. From 2015 to 2019, that increased to 570 tons annually. In 2020, despite the pandemic, purchases reached 650 tons. In 2022, 915 tons. And in 2023, central banks purchased 1,037 tons of gold, the highest annual total since 1967. We're not watching nations gradually reduce their reliance on gold as technology advances and digital currencies emerge. We're watching the exact opposite, an acceleration of gold accumulation by governments at a pace not seen in over half a century. That acceleration is telling us something about what nations see coming that the general public doesn't yet understand. I needed to identify which countries are driving this buying surge and why. So I compiled detailed data from central bank disclosures, World Gold Council reports, and customs data tracking gold movements. The pattern that emerged is clear and geopolitically significant. The largest buyers over the last 3 years have been China, with approximately 435 tons. Officially reported Turkey adding 220 tons. India purchasing 160 tons, Poland buying 130 tons, Singapore acquiring 120 tons, and several Middle Eastern central banks collectively adding over 200 tons. What connects these buyers is they're either countries facing tensions with the Western financial system, countries worried about potential future sanctions, or countries deliberately pursuing economic independence from dollar dominance. They're not buying gold for investment returns. They're buying gold as insurance against financial weaponization and as foundation for an alternative economic system they see emerging. I interviewed Dr. James Martinez, who spent 14 years at the Federal Reserve Bank of New York before becoming a professor of international finance at Columbia, and his explanation of why nations continue holding gold was delivered with the weight of someone who's seen the system from the inside. Gold serves functions in international relations that no other asset can replicate, he told me during our video interview. When countries negotiate trade agreements, security partnerships, or financial support packages, the amount of gold in their reserves affects their perceived strength and reliability. It's not rational in a pure economic sense. You could invest that capital in productive assets generating returns, but it's entirely rational in a geopolitical sense. Gold signals that your nation has resources that can't be frozen by sanctions, can't be devalued by another country's monetary policy, and can't be questioned during crisis. That signaling value is worth the opportunity cost of holding an asset that doesn't pay interest. The role gold plays during financial crises reveals why nations refuse to abandon it despite the costs. I researched major financial emergencies over the last 30 years and discovered a consistent pattern. When normal financial channels freeze, gold becomes the currency of last resort between nations. During the 1997 Asian financial crisis, several countries used gold reserves as collateral for emergency IMF loans because their currency and bond markets had collapsed. During the 2008 global financial crisis, central banks conducted gold-backed currency swaps to provide liquidity when interbank lending markets seized up. During the 2020 pandemic, when supply chains broke and payment systems strained, gold reserves gave countries the ability to settle critical trade transactions when normal banking channels were uncertain. These crisis functions of gold aren't theoretical. They're practical and proven, which is why every nation wants substantial reserves before the next crisis hits, rather than scrambling to acquire gold when it is desperately needed and prices are spiking. I spoke with Catherine, who manages reserve strategy for a sovereign wealth fund controlling over $400 billion in assets, and her perspective on gold reflected practical institutional thinking. Our country holds gold, not because we expect it to outperform stocks or bonds over the long term, but because we need assets that maintain value and acceptance when everything else is questioned, she explained candidly. If there's a major geopolitical crisis tomorrow, a cyber attack on banking systems, a pandemic worse than COVID, or a military conflict disrupting trade, we need reserves that remain liquid and acceptable to trading partners. Gold is that asset. We can use it to settle energy imports, secure food supplies, or obtain emergency credit when normal financial relationships break down. That optionality is worth more than any interest payment we're giving up by holding gold instead of bonds. The graph I created showing the correlation between geopolitical tension and gold reserve accumulation is striking in its clarity. I plotted major international crisis events over the last 20 years against net central bank gold purchases in the 6 months following each event, and the relationship is nearly perfect. After the 2014 Russia annexation of Crimea and resulting Western sanctions, central bank gold purchases increased 43% in the following 2 quarters. After the 2018 escalation of U.S.-China trade tensions, purchases rose 37%. After the 2020 pandemic revealed supply chain fragility, gold buying surged 59%. After the 2022 Russia-Ukraine war and unprecedented Western sanctions, freezing Russian dollar reserves, global central bank gold purchases hit record levels, up 78% from pre-war averages. Every time the international system experiences stress that calls into question trust, currency stability, or financial access, nations respond by accumulating more gold. The pattern isn't subtle, it's screaming. What makes gold uniquely valuable for nations is understanding that in the hierarchy of international assets, gold sits at the top for crisis scenarios. I interviewed Thomas, who negotiated sovereign debt restructurings for 15 years and dealt with countries facing financial collapse, and his explanation of gold's special status was illuminating. When a country is in deep crisis, its currency is worthless, its bonds are in default, and its promises aren't believed, gold is often the only asset it can use to secure necessary imports or emergency financing, he told me. I've worked with governments that pledged gold reserves as collateral for food and medicine imports when their credit was destroyed. Gold got those deals done when nothing else would. That's not because gold has magical properties. It's because gold is universally recognized as having value that transcends any single country's economic condition or political situation. Nations remember these crisis episodes, and they maintain gold specifically for that worst-case scenario, even if they hope never to face it. The opportunity cost of holding gold is substantial, and nations know it, which makes their continued accumulation even more revealing. I calculated the annual cost countries pay by holding gold instead of interest-bearing assets. With 35,000 tons held globally and alternative investments potentially yielding 4 to 5% annually, nations are collectively forgoing approximately $40 to $50 billion in annual returns by maintaining gold reserves. That's not a trivial amount. That's enough to fund significant development programs, infrastructure projects, or social services. Yet not only do nations accept this cost, they're increasing gold holdings despite it, which tells you how valuable they consider the insurance and strategic benefits gold provides. When you voluntarily give up $50 billion annually in returns, you must believe the alternative value you're receiving is worth substantially more. I spoke with a former government official from a European country who worked in their finance ministry during the Eurozone debt crisis, and they shared insights that aren't publicly discussed but reveal how nations really think about gold. During the Greek crisis, there were confidential discussions at the highest levels about whether Greece should sell its gold reserves to meet debt obligations. They told me, speaking on condition of anonymity. The answer from creditors was interesting. They said, we'll restructure your debt, we'll provide emergency loans, we'll help manage the crisis, but don't sell the gold. Keep the gold because if this crisis gets worse and spreads, you're going to need it, and so might we. That conversation revealed that even creditor nations who wanted Greece to meet obligations recognized that gold serves a function beyond just financial assets. It's the foundation that allows you to rebuild when everything else has failed. The competition between nations for gold reserves adds another layer explaining why holdings continue growing. I obtained data showing that gold as a percentage of total reserves varies dramatically by country, creating what some analysts call gold jealousy. The United States holds gold representing approximately 78% of total reserve assets. Germany is at 71%. Italy and France are around 68%, but emerging economic powers have much lower percentages. China's official gold represents only 4% of reserves. Russia has increased to 21%, but still trails Western nations. India is at 8%. This disparity means rising powers are playing catch-up, trying to increase their gold percentage to levels comparable with established powers, driving substantial buying that will likely continue for years or decades until some equilibrium is reached. The conclusion I've reached after researching why nations continue to hold gold reserves is that it serves as the foundation of sovereignty in the international system. Countries can print their own currency, issue bonds, and create financial assets, but they can't create gold. Holding substantial gold reserves signals to other nations and to markets that your country has real, tangible wealth that doesn't depend on trust, promises, or another country's goodwill. That signal matters enormously in a world where financial warfare, sanctions, and economic coercion are increasingly common tools of statecraft. Gold is the asset you hold so that no other nation can cut you off from the global economy, so that in crisis you have resources others will accept, and so that your sovereignty remains intact even when political relationships fail. These aren't abstract considerations. They're practical necessities in a multipolar world where trust between nations can't be assumed. The ending I want you to understand is that gold reserves aren't a relic nations maintain out of tradition or ignorance about modern finance. They're a strategic tool nations are actively accumulating because they see a world where trust is declining, where financial systems can be weaponized, where crises can emerge suddenly, and where having assets that don't depend on anyone else, its promises could mean the difference between weathering a storm and complete collapse. The fact that nations are buying gold at the fastest pace since 1967, despite all the costs involved, is irrational. It's perhaps the most rational thing governments are doing, preparing for scenarios where the normal rules don't apply and only tangible, universally accepted assets matter. When the finance minister told me gold determines who gets to have the midnight conversation, he was revealing how power really works at the highest levels of international relations. Nations that hold gold have options when crisis hits. Nations that don't have to accept whatever terms others dictate. That's why countries continue to hold gold reserves, and why they're increasing them at accelerating rates despite living in what we're told is a modern digital age. Gold is the most ancient form of money, and simultaneously the most modern form of insurance. And nations understand that combination gives them something no amount of currency or bonds can provide. Unquestionable sovereignty when trust disappears and only real assets matter.